mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to break down your barriers from beginning to dividend. Now, if you're just joining us for the very first time, a huge welcome. If you're trying to get up to speed with the basics, we have a podcast called Get Started Investing, which will get you from zero to feeling confident about starting in the markets. Otherwise, let's jump straight into it. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We have just finished an interview with expert investor all the way from New York who doesn't just invest in American companies but invests around the world and, quote, emphasizes non-technology businesses.
Yeah, fascinating. So we sat down with James Reynolds, who is the founder of Tenebrist Global, as he said, Ren, a US-based fund investing in a concentrated portfolio of founder-led growth businesses.
And in this interview, we unpack two of those founder-led growth businesses, a restaurant chain in China and a retail chain in Poland.
Yeah.
Not often we speak about Polish stocks on the podcast.
No. Now, a reminder that we are licensed, but we're not aware of your personal circumstances. So any information on this show is for entertainment and education purposes only. Any advice is general, and these are not buy, hold, or sell recommendations because we do chat about portfolio positions in his portfolio.
Yeah. Now, one piece of housekeeping before we get to the interview. You've probably seen it on our social media or heard it on the podcast, but we are very excited to be launching our second book. It's called Don't Stress, Just Invest, and it is here to answer the question of what is the absolute simplest way to get access to the stock market and build the wealth that I need and then get out and get on with my life.
So easy.
So pre-sale is available now. Links are in the show notes, but wherever you buy books, if it's online, you can sign up for the pre-sale. If you buy books in person, it'll be hitting the shelves on the 22nd of August. But would love you to get around it and hope it helps you on your investing journey.
Yes.
But Bryce, without any further ado,
keep an eye out. We are doing a launch party. Thanks to Dimmix.
A little bit more ado.
Yeah, we're doing a launch party thanks to Dimmix. Keep an eye out on our socials for that. I think would be the place on our Instagram at a pub somewhere in Surrey Hills in Sydney.
Yes. Unfortunately, Dimmix couldn't fly us around the country
next year.
That means we have to write another book.
No, we'll just pressure them into doing it.
Anyway, that's a conversation for another day. Let's get to this interview with James, the founder of Tenebrist Global.
So James, a massive welcome to Equity Mates. Great to have you.
Yeah, thanks for inviting me on. I'm really excited to get chatting about whatever questions you guys have.
Well, let's get stuck in. So the first one, we always love to understand a bit about our guests' investment philosophy. So how would you describe yours?
Yeah, so high level, I'm a concentrated long-short growth investor. I come from kind of a family of funds where we hold very chunky positions. In our previous firm, we held one investment that got up to 40% of the portfolio. Now I'm kind of maxed out around 25, 30%. But generally I'm holding 5 to 10 longs. Smallest positions are generally kind of high single digits, but I'm trying to get everything up to 15 to 20% kind of core position. Which is very different than kind of how a lot of other people approach it. It's pretty much a one-man show, so there's not a tremendous amount of bandwidth, so it works for me in terms of how many companies I can cover, but it's also, how many ideas can you have at one point in time that are really that attractive? I feel like there's 4 different pieces of an investment philosophy, kind of first being, are you long short, are you long only, what's your net exposure? So like I said, we typically have about 5 to 10 longs, typically about 5 to 10 shorts, very concentrated positions on the long side, not quite as concentrated on the short side. So on the short side, it's typically 1 to 2% positions. The second piece, kind of that portfolio construction, right? Number of positions, I already kind of talked through that. Sizing as well. In terms of like how much cash we hold, we're generally holding 0 to 15% cash. That's kind of where I like it to be, just based off of the opportunity set at any given point in time. Thereafter, the portfolio construction gets a little bit more complex. I really come to only hold one investment per distinct bucket that I have for my portfolio. So that's kind of like my unique take on portfolio construction. The next kind of part is like what types of scenarios really get you excited. I'm looking for founder-led growth companies. I really don't look at any businesses growing slower than maybe 15%. And every new position, there's, I think, maybe one position in the portfolio that kind of got grandfathered in that's not currently founder-led. But the rest of the book, 85% of the portfolio, and anything new that we're investing in is founder-led.
So there's some interesting elements there. I don't think I've come across many fund managers that have such strict categorizations across geography and across sector, and you're just looking for the best idea for each of those categorizations. And then also really focusing on founder-led businesses. We've spoken to a few fund managers that are really looking for those businesses and unpacked why. When we were researching your fund before this interview, one other thing that we came across that we thought was quite interesting was that you explicitly emphasize non-technology businesses. Now, it's 2023, and we've lived through a decade and a half of just tech dominance. So that's a bit of a contrarian take from you. Why emphasize non-technology businesses?
I think a lot of it comes back to trying to find these unique, idiosyncratic, lower core. I'm never going to say uncorrelated because everything's pretty correlated at this point in the global equity markets, global asset class markets. But I'm looking for any areas that could be kind of lower and less correlated, and those tend to be non-technology, and they tend to be these global markets that maybe all of these big, mega funds, Tiger Cubs, et cetera, Cathie Wood, ARK funds, aren't looking at. So that's kind of the launching off point. Is that was like one big realization I had is kind of, if I want to really create a diversified portfolio of unique uncorrelated assets, like you're going to have to look outside of technology. You're going to have to look out of the US, outside of the UK, outside of Germany. Other than that, I come from a background of technology investing. My previous fund was, primarily focused on US and China internet. Now I feel like I have a good perspective on the types of businesses that are not going to be impacted by internet disruption. And so I feel like I have a unique perspective with all of that background experience. Don't get me wrong, we still have some tech exposure. It's about 15-20% of the portfolio right now, but it is, on a go-forward basis, it's always going to be kind of sub 30%, I think.
So, James, we enjoyed reading your recent investor letter on the importance of being a generalist. So, can you just define for us, firstly, what you mean by generalist?
In the investment context, I think it can be a variety of different things. So, you can be a country generalist, you can be an industry generalist, you can be a scenario generalist, right? So, someone who invest in compounders, but they also do spin-offs. Someone who invests in US and then China and then Brazil and then Australia. Someone who can do consumer, tech, industrials, healthcare. So that's what I'm talking about when I'm talking about a generalist.
And in your letter, you introduced this concept of an unkind environment, something I hadn't read about before, and explained why being a generalist is important in an environment like that. So let's start at the beginning for people like me who haven't come across it before. What's the difference between a kind and an unkind environment, and why is investing the latter?
Yeah, so I came across this concept in a book called Range. And it's similar to the idea of a complex adaptive system, but like an unkind environment is, a system, or it could be a game, any type of industry, et cetera, any environment where the rules can change overnight without, you having any idea that that's coming, right? There's paradigm shifts, there's regime changes. And what that means is that like any lessons learned during any particular one of these regimes, will work very, very well for that period of time, and then things will stop working all of a sudden. And it's hard to kind of figure out why this previous strategy wasn't working. So the opposite of that is the kind of environment. The rules never change. It could be like a very, very simple board game, a Sudoku, right? Playing an instrument, playing chess, tennis, right? So like these very basic sports and games generally tend to be kind environments. And what we see in sports is that those who have excelled at these games or these sports and these kind of environments are those generally who have spent the most time, right? Like Tiger Woods had a golf club in his hands at age 2 or 3 or whatever, right? So like that's a great example of just putting in the hours gets you to that elite tier in a kind environment. In an unkind environment, it isn't always that case. Regards to investing specifically, I think a good example is just think of whoever your favorite investor is who had a great, 5 to 10 year period and then went on to have, pretty horrendous performance thereafter, are generally kind of a product of this unkind environment, right? They learned a specific lesson or, set of lessons that worked very well in that regime. And then when things changed, they weren't really able to adapt. So, in order to adapt, you need to have a variety of different, knowledge and experience. It could be, like I said, countries, industries, situations like, spinoffs, compounders, high growth, low growth, value growth, whatever you want to call it. But also just, topics, knowledge of topics across, outside of investing, like history, understanding of, health, anyone with a healthcare background or something, that could have been a huge benefit during COVID, things like that.
Yeah, it makes me think of so many people start investing and they get told to read the Benjamin Graham books, Intelligent Investor, if they're brave, Security Analysis, and they get introduced to all these ideas of like traditional value investing, cigar butt investing, nets, all of that. And then so many people, and I include myself in this bucket, then start trying to apply that to the real world and try to, get a stock screener and filter for companies trading below their net asset value and stuff like that. And you quickly realize that like the rules of the game have changed, and a lot of the deep value plays that made sense back in Graham's day and Buffett's early days no longer make sense, or they've just been, arbitraged away or whatever. And the rules of the game are very different. And, Buffett is a classic example of an investor who learnt that and changed the rules of his investing rules as he developed.
But yeah, I mean, it's a great example, right? Like the cigar butt stuff has gotten commoditized and competed away. And, there's more data. Access to data is, significantly different than back then. He probably had access to data that, very few people had, and he was able to kind of capitalize on that advantage. Those advantages don't really exist anymore. And I think kind of like one of the other bigger regime shifts that I've observed definitely predates my investment experience, but it's just kind of like how correlations have increased in the global equity markets over time. And I think that's kind of my take, is that you really do need to find these unique exposures in Poland, in Nordics, in Japan, small mid caps, non-technology, to kind of find the only pockets that are left that aren't 100% correlated with the S&P 500, with whatever, large index you want to talk about.
So James, being a generalist allows you to recognize sort of patterns and synergies around the world, as you've sort of explained. Can you share some examples that you've come across that sort of illustrate this?
There's 3 different benefits to being a generalist and like the synergy you get from that. So the first one is you can recognize certain types of companies across different countries. So one example I've used a bunch of times is there happens to be like five or six different publicly traded accounting software firms across different regions. You've got Intuit in the US, Fort Knox in Sweden, Epsilon Net in Greece, Xero in Australia, New Zealand, Money Forward and Free in Japan. I'm sure there's others that I'm missing. But that if you've studied one of them, that enables you to kind of ramp up quicker on one of the others, a little bit quicker than maybe someone who's net new to accounting software. And then there's kind of like business model synergy as well, right? So like one that's common now, obviously, is subscription. Gyms have subscriptions, streaming services have subscriptions, and any type of media, newspapers, New York Times, et cetera, everyone's kind of going to the subscription model. So if you've studied one subscription model, you're not going to be an expert on the next one, but you're going to have decent leg up on at least understanding kind of the dynamics around a subscription model, churn, pricing, margins, retention, kind of the important things to be thinking about in managing and investing in a subscription business. And then the last one I think is like most important to me, and where I think like the synergy has been most impactful, is across like a single company's value chain or ecosystem. In the previous ones, like if you're a media analyst, you're going to be looking at Spotify, Netflix, New York Times, right? You might have the same people researching the same types of businesses, but I think the big difference for me has been, I can take maybe like the restaurant industry as one example, is I've studied restaurants, I've studied some of their suppliers, I've studied payments, restaurant POS like Toast, I've studied the restaurant delivery businesses. So I've studied different pieces of the value chain, from the consumer all the way down to like the farm, Whereas those are very different. Each piece of that value chain is a very different sell side analyst. So you're not gonna have the POS payments guys. They might be the food delivery guys, but the restaurant software guys are not going to be. The restaurant guys are definitely not going to be, and then the restaurant suppliers are definitely going to be different than the restaurant guys. So you've got 3 or 4 different groups of sell side analysts all trying to figure out this one business.
It makes a lot of sense, but I guess the challenge for generalists, and especially generalists that are then investing globally, is the universe is just so large. 40,000 listed stocks. I think these days they class 27 markets as developed markets, another 22 emerging or something like that. And to your point, you can sort of find these synergies and you can understand value chains better if you are a generalist and you read deeply and widely. But it does just mean you have to focus your efforts in certain points or somehow find more time in the day than anyone else. So how do you do it? How do you start filtering a universe that large? How do you decide what rabbit holes you're going to jump into and companies you're going to look at?
Yeah, I've had to find ways to limit the universe. Founder-led companies and having a strict growth rate that I stick to as a minimum threshold, that goes a long way to filtering the universe. But it really comes back to that portfolio construction, right? I'll go region by region or industry by industry, and I'll just apply those filters to a specific country. I'll go and I'll exclude maybe a handful of industries that are generally known to be lower quality. Like I'm probably not going to invest in maybe like a construction company or banks, but I'll look through every company in Japan growing faster than 15%, and I'll send all of them emails trying to talk to the management team. So that's really where I start. Is I go country by country, I go industry by industry, and I use those founder led and the growth threshold as a starting place, and then I'm just trying to see whoever I can kind of talk to, in the next few weeks, and I'll go country by country and just study that country, all of the available investments that kind of fit that criteria, over a few months. But there, I'm thinking about base rates. Base rates basically are just kind of like empirical evidence around, having to do with the stock market, having to do with industries and business, and I'll apply those as well. So like founder-led companies outperform, profitable companies outperform. There's certain countries that generally have had historical higher equity returns. The US, Nordics companies, Australia, New Zealand have generally had the highest, they're the best performing equity markets. Growth and profits is really important. So that growth component, smaller companies generally outperform. I'm applying all of those things to kind of get to a smaller universe that when you bring all of these base rates, all of this empirical data together, should generally, be an attractive pool of fish to fish in.
James, we're going to take a quick break. Now, before the interview, you sent through 6 companies that we had never heard of. Now, if you're interested to find out what the 6 are, head to our Instagram today to find out what the 6 are. But on the other side of this, we're going to unpack 2 of them. Welcome back. We're speaking with James Reynolds from Tenebrist Global, a US-based fund that invests in a concentrated portfolio of founder-led growth businesses. Now we're getting to the exciting part where we unpack some of the positions in your portfolio. In doing research, there are a number of companies that you sent through, and I'm going to put my hand up and say I hadn't heard of a single one of them. Had you, Ren?
Same, yeah. There were 6 companies and we didn't recognize any of them.
Yes.
So that's a good starting point. We're going to learn something here.
Love that about investing. So, James, what we'd, I guess, like to do is you choose a couple of companies in your portfolio. Let's just start with the first and maybe tell us about the company. How did you find it and what it does?
Yeah, so we'll start with one that's been in the portfolio since 2020. It's a company called Jiumaojiu. It trades in Hong Kong. It's a restaurant incubator. I found it because, I've already talked a little about the food space, right? The food value chain. So I've spent a lot of time in my previous firm, mostly focused on restaurant and food related technology, restaurant delivery, grocery delivery. And so when I launched my firm, when I was really looking to expand outside of US and China internet into US and China offline, one of the areas I decided to focus on within China was the food landscape. And I started with restaurants. So like I said, I screened for restaurants, growing rapidly, founder-led in China. And you get a small handful of companies. I thought the most attractive one was going to be the blue chip there, which is a hot pot company called Haidilao. But after I started doing some initial research on Jiumaojiu, it was a recent IPO at the time, I came across their unit economics and I was just blown away. Unit economics for any type of like box expansion story, it could be a restaurant or a retailer. The unit economics are really important because that determines how rapidly you can grow. How many boxes, how many profits from, a handful of boxes does it take to kind of launch a new store, right? So their unit economics were particularly attractive. We can get into that in a little bit. They had a legacy brand, which is the Jiumaojiu brand. There's more like a family-oriented, very, very large format store. It was kind of in secular decline, but they were using the profits from that as a cash cow to invest in a new concept called Tire, which is a rapidly growing sauerkraut, pickled fish, spicy soup restaurant that, like I said, the unit economics were particularly compelling, which meant that they were going to be able to continue to grow for a long period of time. That Tire concept itself has about 570 locations. They're adding about 100 to 150 per year. So I'm typically looking for kind of that, 15 to 30% unit count growth. It'll be the same idea for the next concept, the next investment we talk about as well. But this year they'll do about 900 million USD in revenue, with about 200 million in operating profit, and it's only about a $2.4 billion EV. So it's about 10, 11 times.
So I think the next question was going to be what's the thesis, like what's the bull case? But I think you've touched on a number of elements there. Good unit economics, only 570 stores in a country like China. I imagine there's a heap of growth runway. I think Starbucks alone has more than 6,000 locations. So there's growth there. It's profitable. But is there anything else in the bull case or why you liked this particular opportunity in China over, the blue chip that you mentioned or any of the other ones?
Yeah, it really comes down to why the unit economics are so compelling. So I'll just start. They're vertically integrated. So they have these central kitchens where they do a lot of prep for the foods. The ingredients don't show up to the store. They show up to the central kitchen. They do a lot of prep there. And then that's moved over to each individual location. And that saves a lot of in-store labor because you basically just need like one person in the kitchen to heat the food up. So it doesn't take as much prep, so you don't need as many employees per store. They're vertically integrated into the farming of the bass fish itself and also other key ingredients for the pickled fish soup dish, such as the peppercorns and the cabbage as well. So the vertical integration means they have control over cost and quality. So that contributes to the strong economics and also the strong user experience. The other components of the store experience that drive the strong unit economics are you have a couple people roaming around the stores, but there's no dedicated waiters. Like it's somewhere between kind of like a sit down restaurant and a Chipotle. You don't go through that assembly line like you do with a Chipotle. You do order, but you order from a QR code. The drinks are self-serve. So that's similar to like a Chipotle type concept where you go up and you can get water or different types of teas, different types of drinks, kind of at a dedicated area of the restaurant. And like I said, there's no chefs either. So there's very little labor in the store. And so people are in and out very quickly because of that prep time as well. Because the food is already prepped in the central kitchen, you're not spending a lot of time cooking it. So you walk in, you sit down, you see the QR code, open up the menu, order, comes out in 10, 15 minutes. You can be out in 30 minutes. So that means the table turnover is very quick. You can get people in and out very rapidly. So those are kind of the reasons why the unit economics are so compelling.
So when you're analyzing a company like this, James, what are the key metrics that you're looking at? So
you mentioned that Starbucks has 6,000 restaurants. I'm looking at the unit economics and I'm looking at the addressable market opportunity. So the unit economics, like I said, kind of drive the pace at which they can expand because you need cash flow to invest into CapEx, obviously. and their payback periods are very, very quick. So it's a little over $300,000. Obviously, they're in renminbi, but it's about 300,000 USD to open a store. Those stores do, at a mature level, about 2 million in USD revenue. And then the contribution profits from that are about 20-25%. So we're talking 400,000 to 500,000 in profit per store, which is a little bit less than a 1 year payback period. So after a store is up for a year, the profit from that individual location can be invested in an entire new store for next year. So that just shows you how rapidly you can kind of take cash flow, reinvest back into CapEx, and grow it at high rates for long periods of time. The second piece being the addressable market. So like you said, it's China. It's a huge country, obviously, but we still want to have an understanding of what the long-term opportunity is. So like I said, there are 570 stores at the end of this year. They target penetrating all of the premium malls. So this is a mall-based concept. So there are no standalone locations really yet. And there are 3,000 premium malls. There's 10,000 non-premium malls. So there's 13,000 total malls in China. And then theoretically, they could expand into non-mall, standalone formats as well. So they're 20% of the penetration of the premium malls. They are 10% of kind of what they could be long-term. So we're not really worried about the addressable market opportunity. And then after you make the investment, it's pretty much just monitoring the ongoing business results. So in restaurants, in any kind of box concept, it's going to be same-store sales growth. So you want to see positive same-store sales growth generally over time periods, especially with inflation and whatnot. So yeah, we monitor revenue, margins, same-store sales growth, pretty much the same things for every single box type concept. Because you just want to make sure that that expansion and competition isn't, the expansion isn't cannibalizing and competition isn't stealing share, which would mean deterioration of the economics. And then that would lead to negative same-store sales growth.
Yeah. Now, the final question is just around the bear case. What could go wrong? And obviously there's this sort of, the business fortunes could change. The customers aren't coming through the door. They're opening stores that are becoming less and less profitable and stuff like that. And that could be one scenario. But I'm also interested in like the unique bear case that comes from investing in a company in China, especially when you're in the States and you're trying to analyze it from the other side of the world. So, how do you think about the risks, and I guess how do you stay on top of an investment like this and make sure you're across what's going on the ground when you're in New York?
Yeah, so the China specific risk is something I think a lot about. I've invested in a handful of Chinese companies, and I've watched a ton of different industries and companies in China, followed them over the years. And I've come to really appreciate the China risk. And my conclusion is basically, I want to look at companies and industries that are as far away from anything that the Chinese government has interest in as possible. So I don't want anything to do with kind of like flow of data, flow of money, any kind of critical infrastructure, even kind of, healthcare, anything that's more critical to the well-being of the Chinese citizen. I kind of want to stay away from, because those are areas that are very important. I looked at the online education and offline education players that got leveled a couple of years ago. I've seen what's happened with the different we were invested in Tencent. I saw what happened with their oversight in video games and payments. So I think consumer discretionary is probably one of the most interesting areas to focus on, one of the least risky areas to focus on. And even with that, I'm thinking, okay, what could go wrong for China discretionary, consumer discretionary? What could go wrong for restaurants? So I'm thinking about like, okay, what if the government cracks down on restaurants that are highly caloric or, unhealthy, et cetera. So like, I would think of like maybe like a Yum China as being potentially more risky because their food, Taco Bell, KFC, et cetera, right? Like a little more unhealthy versus the dishes that Jiumaojiu and Tyre are offering are, they're not fried, they're not highly caloric. It's, it's fish, it's, soup, it's vegetables and protein and water for the most part. So yeah, I don't think like the government crackdown risk is quite as strong here.
Nice. Well, James, let's turn to the second stock, which was Dino Polska. Again,
has he pronounced that right?
Yeah, you got it. Yeah, Dino Polska. I think I'd seen it on Twitter. I think I'd seen it a little bit, but I'd never really done much work on Poland. Like I was kind of eschewing it for sure. And then I had an intern bring it to me at the beginning of 2021. He was like, "Hey, I think this Dino Polska, this Polish grocery company, is really interesting." And so I was like, I like to just let my interns kind of go free. You should be working on whatever's most interesting to you, or else, if you're bored by some particular topic or company, like you're not going to do high quality work. So like I want them to always be as interested and excited about what they're working on as possible, so that they can produce, the best work possible. So I was like, go for it, man. Take a look at it. Honestly, it took me a while. I had never studied like Kroger or like Woolies or any of the global grocers. I had done some work on grocery delivery, but that's just a marketing and technology layer for the most part on top of it wasn't the grocery store specifically. So it took me a while to kind of understand what was going on with Dino, why this opportunity exists, why they historically had been doing so well. And I didn't even invest. It was 12 months, maybe 12 to 14 months later before I actually made our initial investment in Dino. And the big turning point for me was when I haven't been to Poland yet, but I plan to do that this year. But I went city by city or town by town in Poland. And I was just looking at the competitive landscape. And what you see when you go into these different towns is there's generally maybe 5 grocery options. You've got Dino, you've got a competitor to Dino, like an Aldi or a Biedronka. And then you've got a small handful of these like dingy mom and pop grocery stores, like grocery/convenience stores. In New York, we call them bodegas, and they're like, for anyone who lives in New York and is listening to this, like the ones in Poland are way worse than the bodegas in New York. I think I haven't come across any bodegas in Australia when I've been there, so I think you guys have a higher quality kind of grocery and convenience landscape. But it's dark, if they're small, because they have no scale, they're particularly high priced at the same time. But I was like, okay, you look at Dino, they're very aesthetically pleasing. They have these bright stores with big red Dino logo. They got a nice parking lot. They're everyday low price, so they've the best prices out of any grocery store in the country. It's a much better customer experience, like aesthetically and then from a pricing standpoint. So it became more obvious to me that like the competition that they were really dealing with is these really, really low quality mom and pop grocery/convenience stores. We're talking about rural Poland for the most part, so we're not talking about their big cities.
So I've just had a look at Dino Polska, up 25% year to date. Great returns for a retailer. As you said, in Australia, our retail landscape's a little bit different. It's a lot more concentrated. There's just two. It's just a duopoly, really. It's Woolworths, where Bryce used to work, and Coles, where I used to work. We don't really have the bodega environment. Got to give a shout out though, if you're looking for a good bodega, I just checked, they are listed, Lawson's in Japan.
Oh man.
High quality small format retail, so maybe
I haven't come across them yet. All right, I'll take a look.
Oh my god, we went to Japan, and with all of the food that was available, beautiful restaurants, we only ate at Lawson's.
Now I haven't looked at them from an investing standpoint, but from a sushi and fried chicken standpoint,
very good.
Top rated.
Yeah, they've got great retail, great convenience. I mean, the 7-Elevens over there are pretty nice too.
These guys had a deep fryer next to the cash register. That's how fresh you would get the fried chicken. Just bang.
Anyway, we'll let you research them, and we'll ask you what you think at some point. But I guess going back to Poland and going back to Dino Polska, up 25% year to date. That's a pretty incredible movement for a big retailer. I guess why is that? And is that like what's the bull case here? And is it playing out?
Yeah, so it goes back to the box expansion formulas that I was talking about earlier, right? Like they can grow store count at a similar pace to Tire, right? So we're talking about 20% store count per year, right? So that combined with some operating leverage as stores mature, plus some same-store sales growth through food inflation, through new customers finding Dino or becoming more frequent customers, or spending more per trip, can easily lead to kind of 25 to 35% operating profit growth for the company. So that's kind of like mathematically, right? It's the same thing. The payback periods aren't quite as good as Jiumaojiu, but we're still talking about kind of like a box that can do 8 to 10 million in Polish zloty per year, which I think should be kind of like low 2s billion USD. And then the capex is about 2 to 3 billion zloty. So it's a little bit more, it's a bit longer. It's about a 4-ish year payback period, but they're pumping all of cash flow back into new stores, into capex. And then, we're talking about metrics, right? Like the other piece, it's unit economics that enables you to grow rapidly. And then kind of what's the long-term opportunity? So they're currently at 2,200 stores approximately. So they're not small by any means. But what they do that's really helpful is they report their store penetration broken down by different regions of Poland. And so that's really helpful with kind of understanding the long-term opportunity for them. So their home region is currently about 16 stores per 100,000 inhabitants. So their entire penetration across Poland is 5.8 stores per 100,000 inhabitants. So right off the bat, we're talking about, okay, if every other region gets to parity with their home region, then we're talking about kind of like a tripling of the store count. So, 6,000 to 7,000 stores. Okay. So that's like pretty good. But those areas are still expanding stores as well. The craziest, most dense part of their store network is some areas actually have one store for every 3,000 inhabitants. So 30-ish stores per 100,000 inhabitants. So I'm not going to say that every area of Poland will get to that same density, but that would be, a 5 or 6xing of the store count, right? So that'd be kind of 10,000 to 12, 13,000 stores. So the opportunity is there for them.
10,000 stores it just reminds me how much bigger basically everywhere in the world outside of Australia is,
New Zealand, right?
Yeah, true.
No offense to anyone in New Zealand listening.
Coles, where I was working, at least when I was there, had about 850 supermarkets, and they had other store formats. Woolworths, I think, had about 1,000 supermarkets.
Well, I'm sure those are much larger though, right? Like how big these are, these stores are 400 square meters, right? So their catchment area is like 2,500 to 3,000, citizens, consumers, right? So these are small format stores with small catchment areas. So yeah, I don't know what kind of like the format or catchment area is for like a Woolies or something, but these are smaller and you can pack a lot of them in because of that catchment area.
So James, just to close out, what's the bear case?
The most pushback I get is probably on the addressable market or competition. I mean, those are for any growth investor, which basically to me just means, I start with, like I talked about with my filter, right? I start with 15% growth as my starting point when I'm screening for a potential investment idea, right? I'm not screening for it has to trade at lower than 10 times PE, so that's kind of how I think of like growth versus value. Is like, what is your starting point? Are you starting with like your first filter is growth, or is your first filter valuation? But for any kind of growth oriented investor, like the biggest risk is deceleration in top line growth or earnings growth, because that usually leads to some type of multiple compression. So I'm thinking, the biggest risk for any of these box expansion stories are generally going to be, do they grow 500 stores this year and then the year after that declines to 300? That's a big problem. So it's the TAM, it's the unit economics, the same store sales growth. I'm trying to understand what the competitors are doing. It's grocery, it's a competitive market for sure. So I follow the other guys. Biedronka is a subsidiary of Geronimo Martins, which is a big European grocer. So I'm following those guys, but I think like I said, the pushback on addressable market and competition are probably the two ones I get most frequently. But like I said, I think the addressable market in terms of store count is there. Like I think at minimum can 3x, which would kind of be like a 10-year runway at least. And then in terms of competition, like it's not like these small towns in Poland have no competition. I don't find the mom and pops to be significantly important competitors or threatening competitors, but they are competing with at least like one or two of these other branded chain discount retailers, like an Aldi, like a Lidl, like a Biedronka. So they are competing today without any issues so far. So yeah, I don't know. Those are the kind of things I follow those guys. I try and figure out what areas they're competing in and how those are going so far. And to date, through 2,200 stores, like the competition hasn't been an issue at all.
So James, we are almost out of time, but I just want to wrap it up with one concluding question. We've spoken about a company in Poland and a company in China, and for me, you think about retail investors like Bryce and I, who aren't running a fund and accessing bigger brokers that can give us access around the world. For people like us, we are getting more and more access these days. But the challenge for me is in the research still, especially when we're looking at international companies where there's a language barrier. And short of getting on Duolingo and putting in the time to learn the language, things like earnings calls and a lot of investor reports are going to be in Mandarin or whatever the language is. So how do you manage that as an English-speaking investor looking at companies where they're publishing and speaking in other languages?
Totally. It can definitely be an issue. When I was originally researching Jiumaojiu, I had someone who I've been close with over the years and was interning for me at the time. He is a native Mandarin speaker. He's from China. So that was really, really helpful. So a lot of the time I will try and find interns, teammates that can help me out from those types with backgrounds in those countries, in those languages. So I've had Korean teammates who can help out in South Korea. So there's certain countries that are most difficult with respect to the language barrier. Japan is tough. South Korea is tough. Nordics has not been too hard thus far. So certain countries, just like their English is better, they're more focused on maybe marketing or doing IR for English-speaking countries, the U.S. markets, et cetera. But generally, yeah, if I can't have a conversation in English with the team over there, it's a non-starter. So every company that I'm invested in, I have conversations in English with those teams. But yeah, it definitely helps to have someone who is native, and I try and bring those people on when I can as well. But yeah, that's also a filter. I'll email companies if they don't get back to me. That's a filter. If it's a really compelling opportunity, I'll try and get on the phone with them. But if they say, hey, if they respond and they can't do a call in English, there's no one on the team that can do a call in English, it's generally kind of a non-starter.
And just on that, when you said you email a company, do you just go to their general IR email address, like that's published on their website, their investor relations email?
Yeah, I go to their IR website, and then depending on the size of the company, you're emailing, Amazon, you're not going to get on the phone with Bezos, right? Yeah. But I'm looking at stuff that's generally sub $10 billion market cap. So yeah, I like to have conversations. I might have an intro call a couple calls with the IR person, the IR director, but generally I'm speaking at some point with the CEO or CFO or founder, someone who's on the board.
I think it's an important thing to leave with for people listening. There's no harm in sending the cold email, even if you're not running a fund, and just sort of faking it till you're making it and trying to speak to someone in the company, even if you're just a small dollar retail investor.
Yeah, I think everyone should.
Nice. Well, James, thank you so much. That brings us to the end of the episode today. Really appreciate you taking the time. I'm sure a lot of the Equity Mates community found that really interesting. We don't often hear about, companies from different parts of the globe that you were talking about. So we do really appreciate it. Thank you so much.
No, thank you guys. I had a blast. It was a lot of fun. So yeah, thanks a bunch.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.